All right, today we're going to tackle a big one, investing. I know, it can feel like this super complicated world with all its charts and jargon. But really, the goal is simple. You just want to make your money work for you. And in the next few minutes, that's exactly what we're going to do. Give you a clear, simple framework to get started.
You know that feeling, staring at all the financial advice out there online and on TV and just feeling completely lost? Yeah, you are not alone. But what if I told you there was a much simpler way to think about it? A way to build a solid foundation with confidence? Well, there is. So let's map it out.
So to cut through all that noise, we're going to start with a really powerful but super simple idea from one of the greatest investors of all time, Warren Buffett. And this isn't some crazy complex formula. It's a straightforward rule he created for the average person, and it's a fantastic anchor to have in all this chaos.
And look, the reason this is so powerful is who it's coming from. I mean, when Warren Buffett gives advice, especially advice for regular folks like us, it's probably a good idea to listen. The man built his entire reputation on common sense long-term investing, and this rule is, well, it's pure Buffett. So what is this rule? Honestly, it's beautifully simple. You put 90% of your money in a low-cost S&P 500 index fund. That's basically your engine for growth. It gives you a small piece of 500 of the biggest companies in America. The other 10%, that goes into something much safer, short-term government bonds. Think of that as your stabilizer, your shock absorber, for when the market gets a little bumpy.
And this visual just lays it all out, right? So simple. You don't have to worry about picking the next hot stock or trying to guess what the market's going to do. It's just two buckets, a big one for growth and a small one for safety. It's about as set it and forget it as it gets, straight from the master himself.
Okay, so Buffett's rule is a fantastic way to build wealth over the long haul, but it also kind of opens the door to this incredible, bigger idea, making money even when you're not actively working. And that brings us to the wonderful world of passive income.
So what exactly is passive income? Think about it this way. Instead of trading your time for money, you build or buy assets that just generate cash on their own. You do the work up front, and then the system takes over. This is the dream, right? This is a key to real long-term financial freedom. And there are a ton of ways to do this, you know? You've got the classics like owning rental properties or buying dividend-paying stocks. Then you've got things like bonds or even getting royalties from a book or a song you wrote. But for now, let's just zoom in on one really accessible and powerful option.
We're going to talk about something called REITs. That stands for Real Estate Investment Trusts. Sounds complicated, but it's not. Think of it like this. It's a way to invest in a whole portfolio of properties. We're talking office buildings, apartment complexes, malls, without having to actually buy and manage a building yourself. You get the income without the landlord headaches. Pretty cool, huh?
And this is the number that gets people's attention. A typical dividend yield of around 4%. Now, in a world where every single percentage point matters, a number like 4% really stands out. Let me put that into perspective for you.
And when you put that number side by side with the broader stock market, wow. The S&P 500's dividend yield is hovering around, 1.3%? REITs are typically paying out around 4%. That's more than 3 times higher. If your goal is generating regular income, that difference is a total game changer.
Okay, so this is where things get really interesting. Because the reason all these alternatives, like REITs and bonds, matter so much right now is that the entire financial game has changed. I mean, the rules that dominated investing for more than a decade, they're gone. And that's opened up a whole new world of opportunity.
For years, the mantra on Wall Street was TINA. You might have heard of it. It stands for There Is No Alternative. Basically, interest rates were so close to zero that safe investments like bonds paid you next to nothing. So if you wanted any kind of return, you had to be in stocks. But now, we're in a whole new era. People are calling it TARA. There are reasonable alternatives, and that changes everything. And if you want proof, just look at this chart. It tells the whole story. Back in late 2019, a 2-year government bond got you, about 1.6%? Peanuts. Fast forward to late 2023, and that same safe investment was paying around 5%. That is a huge leap. The 10-year bond tells the same story. This, right here, is the TRA world in black and white.
So what's the bottom line here? It's simple. Bonds, those safe, kind of boring investments, they are firmly back in the conversation. For the first time in forever, they're offering real, attractive income. And that gives you, the investor, more choices and more ways to build a really balanced portfolio.
All right, so no matter what path you choose, stocks, bonds, REITs, whatever, your success is going to be supercharged by 2 universal forces.
We're going to cover them both, but let's start with the first one. It might just be the most powerful secret weapon in all of finance. And it has nothing to do with being a stock-picking genius. It's all about time. Let me throw a little riddle at you. Picture two investors. One of them invests a ton of money over their career. The other one invests way, way less, but they start much, much earlier. Who do you think ends up with more money in the end? The answer is probably not what you think.
Okay, check this out. Meet Alice and Ben. Alice starts investing at 25. She puts in $5,000 a year for just 10 years, and then she stops. That's it. Total investment, 50 grand. Now Ben starts later, at 35. He invests that same $5,000 a year, but he does it for 30 years, all the way to 65. So Ben invested 150,000 euros, 3 times more money than Alice. But look what happens. Alice ends up with almost 200,000 euros more than Ben. How? How is that even possible? It's the magic of compounding. Her money just had more time to grow on top of itself.
And that's why this quote is just so perfect. Look, you can't go back in time, but you can start now. Every single day you wait is another day you lose out on the incredible power of compounding. Time is truly your greatest asset as an investor. It's more valuable than any amount of money you could start with. Okay, so that's force number 1, time. Now for the second universal rule. If compounding is about using time to your advantage, this next one is about managing risks so effectively that it's been called the only free lunch in investing.
This famous line comes from a Nobel Prize-winning economist, Harry Markowitz. A free lunch? What does that even mean? Well, he meant it's pretty much the only strategy out there that can potentially lower your risk without having to sacrifice your expected returns. It's an amazing deal.
And really, it all boils down to that classic advice you've heard a million times. Don't put all your eggs in one basket. It sounds simple, but it's so profound. If all your money is in one single thing and that thing goes south, well, you could lose everything. But if you spread it out, the failure of one investment won't sink your whole ship.
And that is the magic of diversification. You see, the market zigs and zags, right? What's hot one year is not the next. By owning a mix of things, stocks, bonds, real estate, and so on, you're not riding one crazy roller coaster. You're blending all those paths together to create a much smoother journey. It takes away a lot of that stomach-churning stress and helps you stay in the game for the long haul, which, as we just learned, is how you let compounding work its magic.
So that's the framework. It really is that straightforward. Start with a simple foundation, understand the new opportunities out there, and never ever forget the timeless powers of compounding and diversification. That financial maze, it doesn't have to be so scary. You got the map. The only question left is, what's that one simple step you're going to take to get started?